Thank you, everybody, for your patience. All right, Ricky, take it away.
All right, everybody. How's everybody doing today? So, I hope it's okay if I, involve us all. I don't want to feel like I'm on TV, so I don't want to just feel like I'm talking to myself. So, we get some participation in the chat. If you're doing good, let me just get a one. If you're having an awful day, let me get a two.
Oh, all right, go on.
Hopefully, I get a lot of ones in the chat today.
One.
Caitlin's having a good day. Kelly's having a good day. Amy's having a good day. Love it.
All right,
Ethan's
let's
having a
go.
good day. Fantastic. So, it's been brought to my attention that all
1.5.
of you really
All
want to
right.
learn a little bit more about private wealth strategies, aka known as infinite banking. Is that correct?
Yes.
All right. So what I'm going to do today is I'm going to share a little bit about who I am, how I actually found infinite banking and fell into this realm, and then ultimately what it is and how it's able to help you. So with that, I'm just going to go ahead and share my screen. We're going to be pretty quick. It's going to be about a 25-minute long Zoom call. Won't take too long, and then we'll pass it back for questions and answers. So as we see on the screen, you see my little smiley, happy face from when I was 11 years old. To my right, you'll see my mom, and to my left, you'll see my dad. Now, this photo actually stands out the most to me throughout my entire life. And here's why. My last job as a W-2 employee, I was working at Tropicana. I don't know if 11-year-old Ricky knew that I'd be talking about this one day, but I was wearing a Tropicana hoodie on myself. Now, how I actually found insurance was very simple. In 2016, my stepfather actually passed away. In our case, he was a firefighter and a fire chief, and he had everything that I thought somebody could have. He had the 401k, he had a pension, health insurance, life insurance. So I thought we were set up. In 2016, his kidneys actually ended up being in full failure mode. He got an infection in the port, and he ended up just kind of going sideways on his health. We ended up transitioning to life support, which was very expensive, and we could no longer afford it. And we ended up having to pull the plug. Well, I found insurance because, luckily for us, we were part of the very few that actually got a life insurance payout. But I heard about how life insurance had changed. Heard about how you didn't have to die to use your life insurance. And so my father, when he passed, he left me to do four different things. Number one, take care of your friends and your family. They're not people you're born with, but they're people who you meet along the way. Number two, make sure you smile and laugh every single day because time's the most precious commodity. So what are we doing being upset? Number three, you get given a dream, no matter who you are, no matter how big it is, go after it relentlessly. That dream was given to you, and you're the only one who could pull it off. And number four, my father, even though he would run into burning buildings and go into open heart surgeries with whole mother whopper boxers on because he was just a class clown, his only fear was being forgotten. And so he tasked me with building a legacy. So imagine me, right? 21 years old, working at a factory, getting paid, Monday, broke on Thursday. I'm working 110, 120 hours a week, no time, no money, and I didn't know what else to do. Luckily for me, I heard about this book called Rich Dad Poor Dad, and it talked about passive income. And it talked about how your money should be working for you and you should not be exchanging your time for money. And I just loved that idea. So I stumbled into business, became an entrepreneur for about 4.5 years, and then luckily I stumbled into the insurance realm. Within me partnering up with insurance, I started my own brokerage named Lucid. The Lucid came about from my father's four things he asked me in the will. Lucid is actually an acronym. Love you, consider it done. And so the reason why we partnered up is because our family wasn't financially savvy. Money was taboo. At Christmas parties, Thanksgiving, we talked about money. You're going outside eating with your cousins. You don't get to sit inside no more. And so a part of what I've learned is exactly what we're going to go through today. We're going to talk about how my family was a part of the spenders, which equate for 80% of Americans who live paycheck to paycheck. Every single Friday when they're paid, they're usually paying all their bills so they're out of income. And so 5% additionally is on credit cards or going into debt. And we'll see that play out here on the screen. We have this zero line here that represents our income. For 80% of Americans, 105% is the DTI or debt to income ratio. And so we find ourselves going into debt, having a hole in our income. As soon as we get done paying off that debt, we go right back into it. If you talk to a lot of certified accountants or CPAs or public advisors, they'll say, hey, our biggest problem, Cindy, is we have a savings problem. But I argue that. And I'm sure all of you would agree that it's not a savings problem that we have, it's an income problem, which is why all of you are in the call today. We're all entrepreneurs. We're all looking at increasing our income, having our money work for us instead of us exchanging our time for money. So then we become a saver. As a saver, instead of us paying debt and interest, we save up that money and we pay off and we make our major purchases in full, avoiding paying debt and interest. The only downside is, well, we empty our savings tank and we got to start the savings process all over again. But I always heard this old saying, the rich get richer while the poor stay poor. And I never understood it until I seen the wealth creator. See, as a wealth creator, they're leveraging their money into something known as a private reserve account. It's an account where we can save money into over time. When we're ready to make a major purchase, instead of withdrawing the funds, we're going to loan the money to ourselves. Now, because it's our account and it's our loan, as everybody knows, with a loan, there's always some interest and some debt to be repaid. Well, in this case, we're recapturing the debt and the interest. So by the time we get done paying off what we took out, we have more equity in our account than when we started because we recaptured the debt as well as earn interest along the way. And so when we heard that story of, well, the rich get richer and the poor stay poor, this is why. See, private reserve accounts have been utilized in America since the early 1900s by a lot of the most successful families all of us have heard about, from the Rockefellers to the Rothschilds. They've utilized life insurance, specifically permanent cash value life insurance that they can take loans out of. And we're going to talk about why. But first, let's go through a little bit of a visual. See, as we see on the screen, Kelly, we'll see the spenders tab. All the money from the spenders, they hit this lifetime capital potential tank. And it's a really big tank because it's all the money we'll ever make. Well, this money goes down this inflow tube where it's going to get taxed. After taxes, all the money we have is going down the drain. As we know with spenders, 100% of what they make is 100% of what they spend. And so when they want to make a major purchase or go on vacation or get a house, they end up borrowing money, going into debt. We see when they borrow the money, this creates a future obligation on their income where they got to pay that debt back. This is where that hole in the income comes into play. And we see ourselves going into debt over and over and over again until we have that bright idea of saying, hey, something's not working. We got to increase our income, right? Now, how many of you have actually made that same realization that we can't save our way to retirement? We have to increase our income and actually be able to go that way. If that's you, let me get a 3 in the chat. If we know we can't just save, we have to increase the income for retirement, let me get a 3.
3.
I love it. I love it. I'm seeing them come in now. So now we're a saver. I'm pretty sure that's where all of us are, at least at the minimum, right? We have our retirements, our investments. We have more than enough money going after taxes down the drain, and everything additional we're throwing into high yield savings or cash in a shoebox if you're like me, because it's easy, it's liquid, it's quick to get to. And when we're ready to make those major purchases, instead of paying debt and interest, we like to avoid it entirely. So we just drain our savings account, making the purchase in full. And the only downside is now we got to save again. If you found yourself in this boat, let me go back to a 1 in the chat. I want to see how many savers we're working with today. Perfect. I see you, Cindy. Okay, so as a saver, we know we don't want to drain the tank. Amy, I'm with you as well, right? And so this is where the wealth creator comes in. They still operate as a saver. They have their money in their investments and their retirements, but where their main savings go is in a different tank. Instead of it going into high yield savings or cash in a shoebox like me, they're putting their money into a private reserve account. This account, Kelly, as we watch, when we borrow money out of the account, it's staying in the account earning interest, which is why it's collateralized. But we have a liability to pay it back. But if everybody watches the top of the safety line here, here's where it gets interesting. As we recapture the debt, our savings tank is growing over time because we're also picking up that interest. And so the main point of a private reserve strategy is to pick up the 8th wonder of the world, opportunity cost. Opportunity cost is very simply explained as the ability to earn interest on every dollar that will touch your hands, or the ability to give up earning interest on every dollar. And so with the wealth creators in America, they're leveraging their private reserve accounts. They're saving money in this account over time, as we'll see here. And Cindy, when they're ready to make those major purchases, you know, it may take them a year. They may have it ready, whatever it is. When they're ready to make that purchase, they just borrow money from that account. We'll see the accounts growing with interest over time. And then we recapture the debt. So not only do we have what we borrowed, but we also have more money in our tank. Now we'll notice that in this tank, it has a lid and it has a floor. Our investments tank does not have a lid, and here's why. With 401ks and Roth IRAs, they're associated with market loss. And so the money can evaporate out of the tank. Well, inside of a private reserve account, your money is guaranteed to be safe with no loss provisions. And so how the strategy works is simple. How many of us are in real estate? If you're in real estate, let me get a RE in the chat. Because realtors are some of my favorite people to talk to. All right, cool. I see capitals. There we go. Now we're talking. Now people are getting excited again. Great. I'm with the right crowd. So with real estate, we all are very familiar with HELOCs. We own a property. We take it down to the bank. They say, Cindy, your house, it's worth $800,000 on the market. We'll give you a line of credit for $500,000 and you can do XYZ with it. We take that HELOC, we go do the XYZ and recapture it. Ideally, the housing market has gone up in value and now your house is worth $1 million or $2 million. And your loan that you took out, your line of credit, has earned interest. But as we see in 2008, that's not always the case, is it? As we've seen a lot of home foreclosures in 2008 with the housing crisis, with the crash. And so when we look at a place to put our money in to leverage, well, there's 12 different account ideal benefits on the screen. We have tax deferred growth with tax-free distribution. We have safety with guaranteed no loss provisions, competitive returns, high contributions, so you could really put a lot of money in there. Deductible contributions for those business owners who want to lower their taxable income at the end of the year, get some tax write-offs. Some collateral opportunities. You definitely need that if you're going to earn interest by leveraging something. Absolutely need guaranteed loan options with unstructured loan payments. That one's key. This means that you get to choose if you repay your loan and how that would work. We'd also want and need the liquidity, use, and control to belong to us. You can't sacrifice that and give that to the financial institution. And if there are any additional benefits, we'd want that as well. If you would agree that if your money went into an account with all 12 of these benefits, let me see a 12 in the chat. And as I pull up the next screen, we're going to see a lot of the different types of reserve accounts. Not all of them are private. Many are public. So we'll see savings accounts and money markets, certificate of deposits, HELOCs, margin account on stock portfolios, 401k qualified plans, and of course, cash value life insurance. Now, I'm sure a group this size, all of us have at least one of these things in place for ourselves. The most common would probably be a savings account, right? And so with savings, we know that the money is safe in there. It has guaranteed no loss provisions thanks to the FDIC. The tax-free distribution, it's post-tax dollars going into an account. So of course, it's tax-free dollars coming back out. We have high contributions, so we put a lot of money in there. We do have some collateral opportunities, and the liquidity, use, and control belongs to us. The only difference, for those of you who are unfamiliar with certificate of deposits, the only difference between a savings and a CD is the liquidity, use, and control belongs to the financial institution. It's more of a set it and forget it type of strategy. Then we'll look at HELOCs. We talked about how they offer tax deferred growth, assuming the market goes up in value, with the collateral opportunities being the house. But as we see, it's missing a lot of the other major advantages we need to operate a strong strategy. Then we have margin accounts. Now, I love the competitive return and high contributions with the guaranteed loan options. Liquidity, use, and control belongs to us, and we do have collateral opportunities. But Kelly, as you see, the biggest problem we're facing in this situation is we're missing all the tax advantages, and it's a little bit risky because there's no safety. We'll look at 401k plans. 401k plans offer tax-deferred growth, competitive returns, deductible contributions, and additional benefits. But Cindy, here's why life insurance really blew my mind. Because when we look at cash value life insurance, it offers 11 of the 12 different options if you're only a W-2. But if you're a self-employed or a business owner, you can actually structure policies to open up the door for deductible contributions for the business owner as well through key person insurance or cash benefit plans. And so how life insurance works is simple. If you've never heard of infinite banking or private reserve strategies, this is going to be your crash course. You're going to purchase a permanent cash value life insurance, whether a whole life or an index universal life. Of course, if I were to ask everybody what life insurance is to them, we might all have a little bit different answers, but we'd all come back to the same thing. When I die, somebody's going to get paid, right? Let's call it what it is. Now, traditionally, we don't get to have access to that death benefit with a term policy. But in a permanent policy, you can actually access what's called your policy's cash value, which is very simply defined as any money that goes into an account exceeding that cost of insurance will go to your policy cash value. This money can actually be loaned utilizing the death benefit as collateral. Now, because we're loaning from the death benefit, it is a tax-free, interest-only loan thanks to tax code 72E, which states as long as we loan from a life insurance policy, those loans are tax-free upon distribution. And so it's interest only. It's also coming from a permanent life insurance policy that's privately owned and operated, which means that there's no limitations of what you could spend that money on. You can loan out money if you need to pay bills, you need emergency fees, change a tire, or make a major purchase like a house. Ideally, we're spending that money and we're able to recapture it through non-structured payments. You're not forced to pay a life insurance loan off, because if you pass away, life insurance company will just keep the money you loaned because you got to access it while you're here and alive. Now, the benefit of loaning from a policy is simple. the money stays in your account earning interest. And so what does that really look like? Well, when life insurance is designed and utilized properly, it can provide stable growth, cash value collateralization, guaranteed loan access with no annual tax on growth and death benefits. And so what I like to do is kind of break down the market. I hope that's okay for everybody. We're going to go through some numbers in a little bit. Is that fine? Okay. So what we're going to look at first is the S&P 500 price. We're going to look at a timeline of 2004 to 2023. We're going to look at a 20-year window. Now, Todd, the reason why we're looking at the S&P 500 price is because this is where our 401ks and our Roth IRAs, this is where our American market resides. And so I hear a lot of CPAs who say, hey, we get 9% over the last 20 years. That is an average rate of return. But Cindy, did you know the actual rate of return in the 401ks and Roth IRAs was 7.5% once we factor in dollar cost averaging, which is we put $100 at the top, and no matter what the market does at the end, how much is that dollar worth, right? And so we'll see, yes, if you threw your money into a 401k or Roth IRA or into the market, over the last 20 years, your $1 would be worth $4.29. Now, I work with an index company that has this US pace setter, and it's a point-to-point cap strategy, guaranteed no cap with a very high participation rate. And we can see between 2004 and 2023 what the actual pace setter market did in gray. On the 5 to 20 year average, that was 2.8 to 5.5. But due to these limitations in the index strategy, we can see on the low end, it did 17.2. And Cindy, on the high end, the 20-year actual rate of return was 19.94. Now, I do want to point out one thing. When I go ahead and show a case design here in a few minutes, I'm only going to be able to illustrate 6.4%, even though historically we've averaged 19.9. Is that okay with everybody if I'm very conservative with my side of the numbers? Kelly, is that okay? Can I get a thumbs up? Okay, perfect. So here's what that means for us. Well, why would we even consider private reserve strategies? What is the whole point of it? Well, if there was a strategy in the S&P 500 that got 19.94%, here's what it would look like. It would have a 0% floor and 173% participation rate. Now, to explain participation rates, whatever the market does, you multiply that by your participation rate, and that's what you earn that year. So we can see with these limitations, the limited side now actual rate of return is 19.94%. But Todd, here's the true power of private reserve. Let's say you're going to make a house purchase or a deal, and the deal is, I don't know, $50,000. And before you made that deal, hypothetically, and I want to see a 1 in the chat because this is going to be a good deal. If Mitch called you today and said, hey, if you give me $50,000 in the next 4 months, I'll give you $214,467. How many of you would say yes today? If it's a yes, put a 1 in the chat. Is that a good deal? Would we take it? Are we happy with that? I'm seeing a bunch. All right, 3 1s, a 1. All right, good. Want to make sure we're still awake. Amy, Sheila, thank you for participating, right? We would take the deal. That's a great deal. Now, Cindy, I'm not telling you not to. What I want to share with you is what you're missing out on if you don't run private reserve strategy first. See, within a private reserve strategy, you're not going to put the money in and get the 19%. You're going to reposition your money and then loan it back to yourself. Well, the loan is 5%. So would you like to learn how before you gave that $50,000 to Mitch to get your 214, how you could pick up $736,000 worth of interest over the next 20 years by just repositioning the money into a policy first, pulling it back out, and then making the deal with Mitch? If you'd like to learn more about that, let me see a 3 in the chat. All right, cool. Just want to make sure Kelly's really getting involved. Now I see Kelly type in. I like that. Thank you. So here's how it works. I had a client who was 27 years old. He already had a Roth IRA through Vanguard. And so we went on their retirement income calculator. I know it's a little bit small, I'm sorry. But we see right here, he's saving $7,400 annually into his Roth IRA, starting from 27 to the age of 66. His annual salary is $98,000. And we didn't look at any nest egg he had already saved. But he does need 100% of what he's currently making in order for him to retire with. We also were super generous. We gave Vanguard 6.5%. We're going to illustrate 6.4, so we want to be comparative, right? We can see based on the information we provided, when we retire at the age of 66, he may have a retirement savings balance of $603,000 tax-free. What we were able to do is actually leverage his entire income inside of an infinite banking strategy or private reserve account. We could see $7,400 is what we're going to reposition from the Roth into the IUL. So no extra money out of his pocket, just repositioning his savings, getting him a tax-free retirement through the index. He's going to save that $7,400 for 3 years. On the 4th year, he's going to start leveraging his income. We'll see $97,400 go into the account. And Cindy, just to the right, we see him pulling out $90,000. So he's still saving the $7,400, but he's repositioning that extra $90,000 that would traditionally just touch his checking account and then go out to bills and life expenses. And instead, he's going to put it into his policy first, loan it back to himself, and then go pay his bills, then go pay the mortgage. What he's able to do is when he gets to the age of 66, stop saving into the policy, just like he would in the Roth. We can see it's still $97,400 and $90,000 coming out. So he's still saving the same $7,400 and then just repositioning $90,000 of his income back into the policy and back out to go pay his bills. What's really cool and exciting is that he's able to earn interest on all the money that touched the account, plus the interest he's earned, which is $13.6 million. Liquid and available, he has $2.4 million in the account after pulling out $429,000. Now, I know a lot of questions are, what about this loan balance, Ricky? He's never paying it back. What's going to happen? Well, here's the interesting part. We'll see down here, can everybody see that he owes $17.2 million to this insurance company? That's a lot of money, right? Here's the cool thing. If he doesn't pay this money back, his family will only receive $106 million. So Cindy, I know what you're thinking. Well, what happens if he pays that $17.2 million back? Like, what if we're running deals and paying the deals off as we're getting the money back? Well, great. That $17 million just gets added back in the account. He's able to pay that back to his family when he passes. So not only is he able to guarantee his retirement tax-free, $429,000 every single year, but he stopped paying when he was 66, and he's passing on $106 million if he makes it to 120, or any of the numbers in between. But that's one client. What about somebody who wants to, I don't know, make a mortgage payment through this thing and was already saving for retirement? What about a 49-year-old who is saving $10,000 into a 401k every year? He wants to make $60,000 from this stream of retirement to just supplement, add an extra leg to the table. Now he's also in real estate. So the whole conversation was, well, Ricky, I want to make a house purchase. Should I pay it off in full or should I do a mortgage? And I was like, I'd do the mortgage. He goes, why? And I go, wouldn't you like to see how you could earn interest on that mortgage? Have it pay itself off? He goes, I can do that. So let me show you. So in this $10,000 401k that he has, well, before taxes, he has $232,800. Okay. What we did was reposition that $10,000. That's what he's going to save into the account. But then we see he's going to pay off a house. $100,000 goes in the policy the first year. The second year, 13 months in, he's putting another $35,000 in. But then he pulls out $125,000, keeping $10,000 for both years. That's his house payment initial down plus the first year's mortgage of $25,000. Every following year, he puts $35,000 into the account, saving $10,000, and then pulling back out $25,000 to pay his mortgage. What we see is we have him stop saving 16 years into the policy. So 10 years earlier than what he would have saved into that Roth or in the 401k, sorry. At the age of 66, here's the interesting part. Cindy, believe it or not, when he gets done paying for the mortgage in this policy, he can go ahead and do it all over again. He has $174,000 in the account. But in his case, he wants to be able to turn this interest into a retirement. And so what we're able to do is at the exact same age of 66, when he's ready to retire, match his current income of $60,000 tax-free. So he bought a house, saved $10,000 for 15 years, and he's guaranteed $60,000 for life. If he makes it to 120, well, his loan balance is $2.2 million. He doesn't pay that back. His family still has 13.9. So now let's talk about loan balance real quick. This is going to really break it down for everybody. And inside of a private reserve strategy, you should be repaying your loans because it makes financial sense. You're not borrowing from a bank, you're borrowing from yourself. So when you pay it back, you're paying yourself back. Cindy, this is the power of paying off a loan. And for anybody watching, turn your phone sideways if you're on a phone and zoom in. We're going to go right where my mouse is, right here. We're going to look at this year. We're going to see age 66. This client still has a loan balance. They never paid it back. Their retirement is $114,000 tax-free per year. And they have $445,000 in their account. What we're going to see on the next slide, exact same client, but they're going to pay off that loan balance. And what we'll see is by them paying off that loan balance, well, the money doesn't disappear. It goes back into your account and goes back into your death benefit, available for loan again. But what it also did was by repaying that loan, we no longer have $100 and some odd thousand for retirement. we now have 360,000 for retirement. So whether you pay off your loan or you don't, it's still your money. But if you pay it back to yourself, you'll have a lot more available for loans, for retirement, or for your death benefit, whatever your main focus is. Personally, I love this strategy for when we're buying houses, because every single time we make a mortgage payment, traditionally we want to pay off the house in full. But Cindy, did you know you could be missing out on interest for the whole 25 years of a mortgage? Meaning that, hey, in 25 years, your mortgage could have literally paid for itself like it did in that second case design that we looked at. So with that, that's the private reserve strategy in a nutshell. I know we went pretty fast. I told Cindy I'd take about 3 days. Unfortunately, I took about 25 minutes. So with that being said, I'll open it up for questions, comments, concerns, violent reactions, obscene outbursts, or even joyful jubilees. I'll pass it back to you, Miss Cindy.
Thank you so much, Ricky. I appreciate that. I was curious because I'm not a spring chicken. I just had a big birthday and I can now get the senior citizen discount. So what happens when you're a little bit older and you're thinking about doing something like this? How does that work and how will that help me?
Yeah, great question. So first of all, the older you are, just full transparency, the higher cost of insurance. So if you're seeing this idea and this is something you want to look at, I definitely recommend sitting down, getting your personalized case design up so you can really see. Now, how this could help you is the company I work with does do a CMC or combo multi-choice rider. This allows you to do a blend permanent with a term insurance. Allows us to get all that giant coverage that we looked at a super affordable rate at like the 7,400 or 10,000. If we do a lot of research in these types of strategies, they typically cost $2,000 to $5,000 a month. And with how we're able to write them, we're dropping that down significantly. So in your case, Cindy, how could it benefit you? Well, number one, I'm sure you want to make sure your future generations have something that's higher than the foundation you started on. And then number two, I'm sure even though you're a little bit older, you still want to earn interest on every dollar you're making. The only caveat is it might cost you a little bit more money.
Okay. Um, had a question while you were talking, of course, but I was listening. So, does anybody else have a question that they would like to ask? I am sure we have some questions out there because we had a lot of people commenting in the chat. Anybody?
I'm going to start calling on people. What about you,
I
Kelly?
know, I was just going to say
I
Amy. No, go ahead. Who's going to talk?
I already have an IUL.
You
Okay.
do?
I do. I started it, I don't know, a little over a year ago, year and a half ago.
I love it. And was it structured for private reserve strategy, or was it just structured for the tax-free retirement and the death benefits?
I'm not sure, but I mean, I know I can take a loan against it, so.
Absolutely. Well, Kelly, knowing that you have an indexed universal life, what I'd love to do is just kind of sit down with you, review it, and kind of show you how you could use what you have currently for a private reserve strategy. And maybe if you're open, even doing a side-by-side comparison. Since have you had it for a year, we could still show, well, hey, this is what you have, this is what maybe we have to offer, and see if there's any value we can offer into what you currently are doing.
And it may be structured that way because, I mean, was the premise of why I started it in the first place, because I knew I was learning to become a real estate investor, so.
Yeah, you're a rock star, Kelly. I like you. I knew I liked you. I knew it from the jump. She's like, I already got it, guys. I'm set up. I love it. Kelly, if you'd be open, I'm going to go ahead and somebody's going to be dropping my scheduling link in the chat. If you want to just look at a comparison, I could sit down with you. I don't mind looking at what you have and see what we can do and showing you what it is that your policy is available to do. Feel free to set up a call. And do you have any questions for me today?
Me, us still, or Kelly?
Kelly.
No, I don't have any questions.
All
Thank
right.
you.
I'm going to go on to Kevin and Amy and Sheila. What about you three? Any questions for me? Mitch, what does living benefits mean? It means that life insurance you don't have to die to use. Living benefits is actually why I got started in my insurance company. So living benefits, and going back to my father's story, he passed away at 56. He had a life insurance policy. What living benefits means, Mitch, is on the day of diagnosis, when my father had the heart attack or had the severe burns as a firefighter, or his kidneys shut down and he was paralyzed from the neck down, he could have actually accelerated his death benefit tax-free while he was here and alive. So you were actually able to also help clients access $1.5 million on their worst days, not the days they pass away, but on the days they're diagnosed. And I say that's the worst days because we're all in real estate. 54% of all home foreclosures are directly tied to critical illnesses and critical injuries. So while all of you are out there helping people get into houses, Imagine being able to come back with another conversation and say, hey, I know I got you in this, but I also want to keep you in it. You should sit down with this guy. Yes.
What
Good question.
if somebody has had a heart attack already and they want to do this? Is that possible? Or again, is the answer it's going to be a little bit more expensive policy?
Great question. So it all depends on the timeline and the severity of the heart attack. What I can tell you for certain without knowing any individual client is I have a couple of clients that have had heart attacks in their past. They were minor heart attacks. They weren't widowmakers or anything severe. They're not on any medications, and they currently have a policy. Didn't cost them anything extra.
Okay.
And
And then my last question before somebody else can jump in is let's say, so what I do in real estate is I help people um, invest in multifamily syndication. So let's say somebody said, hey, I found this great deal. I want to invest in multifamily. Can they pull that out and invest that money into a property, into an investment that's going to be held for like 4 or 5 years? And is that going to cost them more, cost them less?
yeah,
What's that going to do?
a good question. So first of all, can I loan out money from my policy if it's in there to do a multifamily deal? Absolutely. What's it going to cost me? 5.5% on the loan rate. That's all it is. Now, is it going to hurt you? No, because that's really why we're doing this, is to be able to make those purchases. Just as a little bit of an information for you, Miss Cindy. Do you know how Walt Disney actually started Disney World?
I'm thinking, I'm like, it's in there somewhere. I mean, no, I don't think I really know the answer. So why don't you tell me?
So, and you all can do a Google search if this is going to blow your mind. But Kelly, you hit it right on the head. I heard you. He leveraged life insurance. See, what happened is Walt Disney went to over 50 banks in the 1900s. And I don't know why, but all the banks said, Walt, this idea of this mouse that's going to be the happiest place in the world, it's going to be a mouse. The bubonic plague was less than a couple hundred years ago. Man, we're not going to give you a loan for this thing, man. I'm sorry, we're just not going to do it. So he was freaking out. So he calls his brother Roy. And Roy and him were talking. He's like, man, I want to do this, but the banks keep declining me. And Roy's like, well, why don't you leverage your whole life policy? And Walt was like, what are you talking about? And he goes, man, listen, you have a cash value whole life policy. Just loan the money out that you need and go start Disney. So Walt took a loan from his life insurance policy. The loan wasn't more than $60,000, by the way. Now, fast forward over 100 years later, Disney World is a multi-billion-dollar corporation. But this happened for a lot of companies. McDonald's also has very humble beginnings with life insurance, as Ray Kroc didn't take the profits from McDonald's to fund the employees, and he actually pulled the money from his whole life to pay his salary for the first 10 years, which is how he supplemented his income. Betty Crocker, another really good example. Pampered Chef. There's so many different multi-billion-dollar companies, multi-million-dollar companies even, that have all leveraged and utilized life insurance, loaning money out to create those deals to be able to fund themselves. And so one book I always recommend is called Money, Wealth, and Life Insurance. And it breaks down how the super rich have used life insurance to tax charge their savings, to to supercharge their business. And then another book I would always recommend, and I believe it's going to be coming in the chat in a few seconds. So just give it a second. PDFs are coming. The second book I'll be giving out to everybody is called The Power of Zero. And this book talks about how we legally can structure ourselves to get to the 0% tax bracket and make sure that we have a retirement that outlasts us. And I believe that's all of our main focus, is get to the point one day where our money is working for us and we can actually enjoy life. The secret, and I think the problem is, we got to get there a little bit before we can no longer work. Right? If we could retire when we're 45 or 50, that's ideal. But what we see on the government plan is they're pushing our retirement back. They want us working longer. And that's just because I'm a huge fan of, well, if the traditional retirement plan for everybody wasn't working, why do we believe it would work for us? We need something different. And this is something different. So hopefully that helps, Cindy.
Yes, and I see a question in the chat, if I can get it open properly, but I keep messing that up. Well, I don't know. Did we already answer this? Are living benefits the same as long-term care? I have that with my life insurance.
Yeah, good question. So living benefits is not always the same as long-term care. They're actually very different. But with some living benefit riders, you have long-term care available. So with us, we have a chronic illness, which means if for a period of 90 days or more, you're unable to perform 2 out of your 6 activities of daily living, Well, the insurance company we represent, they'll allow you to access 2% of your death benefit on a month-to-month basis. If you had $1.5 million policy, that'd be $30,000 a month that you'd be able to access every single month. So hopefully that helps answer your question.
Let's see. I don't see anything else. We have those. Those are the links to the two books that you suggested in the chat.
Yes, they are. So those are direct PDFs. You don't have to buy them. You don't have to do the audiobooks. If you click on those links, it'll take you right into the PDF download. The first one will be that Money, Wealth, Life Insurance by Jake Thompson. And the second one will be The Power of Zero by our CPA, David McKnight.
Trying to figure out how to do that to help the people who aren't on. And so are they going to be able to access those later? Do you think on the recording or not?
I don't think so. You might have to put them
Okay.
at the bottom of the recording in the chat, unfortunately.
Okay.
But luckily, they heard me say the names a couple of times. So hopefully they just go online. And if you're watching this and you're like, oh, I really want those books, just type in the name of the book, Power of Zero, free PDF on Google. It'll give you the first link. It's by Brizzy. And this second one is the same thing, Money, Wealth, Life Insurance, free PDF download, and it'll give you that as well.
Okay.
Great question, Miss Cindy. Is there any other questions from the chat that I could get answered today? No? Okay, so Cindy, I'll pass the call back to you. Hopefully everybody's enjoyed my little time here today. Todd, I'm looking forward to seeing what you have to share. I know you got some exciting news, so hopefully I didn't put everybody to sleep. Hopefully they're still awake for you. And with that, Cindy, Todd, Kelly, Kevin, Amy, thank you so much for bringing me on the call today. Thank you for having me. It's been my pleasure. And like I said, if you guys are interested in looking at more in-depth information, setting up your own personal Zoom call, inside of the chat, Caitlin dropped my scheduling link. Feel free to just click on that and set up your own time. But when you're setting up your times, just put Cindy down with your name as well, so I know that this came from this call today, if that would be okay.
Yeah, that would be great. Well, the other thing that we were thinking about, thank you, Ricky, so much. Sorry. And I appreciate you coming on. And believe it or not, he's not feeling 100%, but you gave 1,000%. So thank you so much for coming and being on the call with us. I really appreciate that. One of the things that we were going to add here on the end was Todd and I had thought about mentioning that, like I said, we do multifamily. And, that was why I had asked Ricky if you could take some funds from that and invest it into multifamily syndication. We have a project that Todd and I were working on, and we were going to possibly go over it. I guess since we have a small crowd tonight, I was thinking I would see if y'all wanted to hang on for another maybe 15 minutes and get an idea of what that might look like. If you are interested in doing that, I'm looking in my chat. I got 3 messages there that I may have missed. Um, oh no, they're just thank yous. Thank you. Would you guys be interested in hearing a little bit about that? Or would you rather just, Mitch is down for it. Thank you, Mitch. I love this. This is fun. You guys are making me have a good time tonight. Kelly, would you be interested in listening? Sure. Okay. And then we got Kevin and Amy. I guess Amy says yes. I think she gave me 2 hands up there. And then, so I guess we may go over that briefly. Todd, are you open to that still and kind of reviewing? You're on mute.
We can absolutely do that.
Okay. Well, Todd and I work together, and do some multifamily investing. And if you, are not familiar with multifamily, Todd's going to tell you more, but I'm just going to go over this briefly, that Todd is going to be a GP on this project, which means a general partner. And a few other folks are going to be running this property and owning a majority of the property. But then when you have to finance the property, you form a syndication and you have a group of investors that come in and invest in the property, and they own a portion of the property. I currently own about 110 doors in North Carolina and Mississippi, where I am part of a syndication. And I am finding that I really enjoy it much more than being a single family investor, because I don't have to deal with tenants' toilets and trash and take calls in the middle of the night and repairs and listen to tenants saying, I can't pay my rent. So I am starting now to sell off my properties and invest in multifamily. And that's how I know Todd. So Todd and I have been working together for some time, and I'm going to give it up to him and let him explain a little bit more about the project that we're working on. And you guys can hear a little bit about this, and would love to hear some feedback at the end. So Todd, take it away.
Thank you. So, for those of you that don't know me, my name is Todd Snelling, and I am a bit of a number nerd. So, my favorite part of a deal is looking at the numbers and trying to see if the numbers work and what I can return to investors. So, I've done this quite a bit. I've probably looked at over 100 deals, and this most recent deal that I've come across seems to be the best one um, that I've come across, both for cash flow wise and return to investors. And I'll kind of explain that. We are looking to purchase a place called the Butterworth Flats. Butterworth is an old department store that was remodeled about 10 or 15 years ago in Petersburg, Virginia. If you're unfamiliar with Petersburg, Virginia, it sits just south of Richmond, Virginia. It is a up and coming area. There's an old saying in real estate, you want to buy the worst house in the best block. Petersburg is becoming the best block. There's a lot of things that are coming on to Petersburg. I'll talk about those in a little bit, but obviously there's things that are coming on the area will certainly stimulate an apartment building that is already profitable. So our plan is to purchase this building that is currently 100% leased up, that generates between $1,400 and $1,500 a month per apartment. And there are 45 apartments here. There are also another 54 artist studios. So an artist studio is just a big wide open space. Those are rented out to anywhere between $100 to $250 a month. However, the best part about Buttersworth is what sits at that bottom floor. And that bottom floor is an 8,000 square foot wedding/event venue that is currently not being used, but is completely built out, meaning that I don't have to put any money into this. All I have to do is flick a switch and turn this on. So one of the things that I talked about earlier is Buttersworth. This area is starting to blow up. Our particular building, which you see right there, was remodeled in 2014 with historical tax credits. That means the owner went to the federal government and said, you give me money and I will rebuild every apartment, the PM&E, the plumbing, mechanical, and electrical, to your satisfaction if you give me the money. And that's what he did. And he built a gorgeous building. The outside is what was required by the historical tax credits. The inside is absolutely as new as apartment as you will see. And these are fully leased out with 6 to 12 person waiting lists the whole time. This particular building sits right next to a $23 million remodeled hotel called Hotel Petersburg. I'll show you that here in a little bit. But the first returns that we're projecting are just based on us going in and operating the building. There is no value add construction here. We are buying this building cheap enough that we can return a 2.1 equity multiple and an 18 to 20% IRR over 5 years. That is with a 7% preferred return to investors. You'll say, Todd, this sounds like good numbers to me, but I'm going to show you what we can do with that wedding venue. And I know it's late, so I'm going to talk a little bit faster than I normally do. First of all, Petersburg. You're seeing a lot of places pop up on Petersburg that are like scientific companies. Chemical companies are starting to come to Petersburg, but the big thing in Petersburg right now is the building of a $1.8 billion casino. This casino sits about 10 minutes from our building that we're going to purchase. It's expected to bring another $2.8 billion into the area. They predict this casino will be operational by the end of the year in some temporary form. It's been voted on, approved, and they began digging in March. They look for it to be finalized at the end of 2026. This will be a big boom for this city and the places around it. 200-room hotel will come with it. Hotel Petersburg is right next to our building. I will show you pictures of this as I move on. Again, more about the live. I can send this out because I don't want to take up too much of your time, but more information about the casino, why they feel this is the biggest boom to come to the area. This was announced 2 weeks ago. This is about 15 minutes from our investment. This is a Lego distribution facility. It's going to be one of the largest in the country that's coming. This is the building we intend to buy. The building is called Buttersworth. This is Hotel Petersburg, the $23 million renovated hotel. This is North Sycamore in Petersburg. And this is all the build out that's coming. You can literally drive from one end of Sycamore Street up to the north end of Sycamore and see this transformation taking place in this town. This is Hotel Petersburg. Again, I'm not going to go through things, but I wanted to show you the hotel. One of the things that Hotel Petersburg does not have is a wedding venue. They have a woman in a wedding dress on their website, but the biggest room they have is 800 square feet. So our intention is to come in, buy this building, operate the 45 residential and the 54 artist studios, and then we will turn on the asset that I call the event and wedding space. Excuse me. As I said, this is fully rehab. This is not an investment where you wait for the value add to kick in and it takes 6 to 12 months to turn around. We would start this day one. This is our target. We're trying to raise 1.8 million. We are projecting this IRR to be above 20%. Your rate of return would be 20% without the wedding venue. I'll get to the wedding venue in a minute. And again, I'm talking a little bit faster than I normally do. I know people are tired, but this is what the apartments look like. They were all done well in. These are high-end apartments. I would live in these apartments. I've said that before. We have done due diligence. We've had the sewer scoped, and we've looked at every apartment. These are extremely well done. This would be for an upper class person. These are the artist studios that sit in the basement. And here, this is the start of the wedding venue pictures. The wedding venue picture that you see here and here is currently just wide open space. It's not operational. These are some of the pictures of the artist studios. There are 19 open, which we would rent out. Everything is key carded access. Again, you just see how it's extremely well done. This is kind of a video tour of these spots in the basement. And you can see these are all extremely well done, polished concrete. But here's kind of what I wanted to see. This is the wedding space that's currently being used. In 2017, this wedding space did $200,000 a year in income. A $200,000 a year bump for us would be almost a 20% gain in income year one. So essentially, we come in day one, we do a master lease option. We have somebody rent out this space for weddings and venues. We know the typical Petersburg wedding venue or that of Richmond, Virginia is somewhere between $6,500 and $10,000. This wedding venue, like I said, there's no build up. It has a fully commercial kitchen, or I should say a commercial kitchen that would support catering. Alcohol is allowed to be served here, but getting the right license. There are rooms for brides and grooms. There are rooms for separate meetings area. We would just turn this on. This is the rate of return for the property without the wedding venue. And I know you can read this later, but it starts at 5 to 6% the first year, and you see it climb to 11, 12, and 13% in year 5. In year 5, we cash you out either through a refinance and a sale, and we give you your money back, and your equity multiple is above 2.0, and your rate of return is about 20%. But let's see what happens when we add only $10,000 in income to the wedding venue. So that would be us doing one wedding a week, or one wedding a month, excuse me. that would be $120,000. If we added $120,000 to our bottom line, your average annual return goes to almost 38%. You would get 38% return each year at an equity multiple of 2.88, which means you would get almost 3 times your money back in 5 years. We have to show investors, we have to be conservative. We know that this same venue operated for $200,000, like I said, in 2016 and 2017. So we conservatively underwrote this and said, okay, what happens if we only did 10? If Hotel Petersburg came in and said, hey, what if we just run this out to you for $10,000? Your return on investment, your average annual return would be 38%. That's where the value add lies in this property. It's kind of a huge number, but we wanted people to understand where that number came from. So you didn't think, well, that just seems like a crazy number. Um, Again, you start seeing these numbers come back. These numbers start to skyrocket remarkably with that wedding venue just turned on, not built. So I know that's pretty quick. This is the pitch deck. This is my team. Cindy has a copy of this. I can send it out. Cindy has a video of me kind of going into more detail, but I want to be conscious of everybody's time. This is how we use the money. But you should know that when we underwrite a property, we are all in on the underwriting. We think of debt reserves, insurance reserves, operational reserves, maintenance reserves. All that is included in the numbers you see here. Cindy, like I said, I don't want to take up too much of anybody's time, but you have a copy of this and you can make contact with whoever you need.
Yes.
So does anybody have any questions about the property itself or the project? I know it's late.
Yeah.
I appreciate everybody sitting through that.
Amy, Mitch, and I are all in Colorado, and Kevin is not. Yeah, I can't remember. Did I talk to Kevin or not? Yeah, this is just some information that we wanted to throw in at the end. If you're in some sort of um, a savings account that's only making, a small amount of money, you can do something like this to invest. If you're having funds just sitting there, you can also talk with Ricky, and there's always a way to grow your money. And that's really what I want to um, project here is that you can always grow your money faster than savings in things that are some of them are backed by real estate, not all of them. So Ricky's weren't, but mostly what I do is backed by real estate. So does anybody have any questions? It has been almost an hour since we got on. So again, like Todd said, we want to be make sure we're taking care of everybody's time. And if we don't have any more questions, then we can head out for the night and you can go either get some rest or spend some time with your family. Any last questions or comments from our folks who are here? All right. That sounds like we are at the end of our evening. We so appreciate everybody coming and being with us this evening. And I will send out a recording via your email, and you can feel free to reach out to me. I did not drop my information in the chat, but if you signed up, you probably know how to find me. So again, thank you all for coming this evening, and I hope you have a good night.
Thank you.
All right. Bye-bye.